Monday morning. I run the Asia program here, at least I pretend to. But I'm really pleased today to be able to host our colleague from Beijing, Michael Pettis, who is professor of finance at Peking University's Guanghua School of Management, and who's had a long career both teaching at Columbia and Peking University, Tsinghua University, and also before that as a trader and a banker and risk analyst on Wall Street. I think has given him a perspective that's just different from the often dry economics that we get. Michael, when we first got to know each other, was extraordinarily outstanding in the sense of standing out from the crowd and his views on where China's economy was going. And the crowd has been moving closer to Michael, I've watched over the last few years. And I think, given that we have the 19th Party Congress coming on us, it's going to be, for people like us, this is what we're going to talk about for the next month and a half. This is really a good time to take a look at the fundamentals of the economy and what opportunities and risks might be posed by choices that be confronting the Party Congress and leadership, both at the Congress and in the months that follow. Michael, welcome back. He's just gotten off a train from New York, which is why we're running a little bit late. Thank you for your patience. We can get this started.
Thanks very much. What I wanted to do is, rather than make predictions, and I don't make any predictions, especially about the future, is sort of try to set out as logically as I can what I think are four different sort of states of affairs, four different ways in which China could be. And I think from there, then it becomes pretty straightforward to try and figure out what the policy options are, because you sort of know where you have to end up, and that's sort of how I think about it. Then the question for policy is, what are the various paths you can take to get where you're going to end up, and what are the good ones and what are the bad ones? Now, a lot of economists would be very uncomfortable with this approach, because our basic assumptions, we assume that there is greater flexibility and we're closer to a kind of equilibrium in the system, and so therefore it's really hard to set out the different options, because they're quite close to each other, and there's a lot of sort of self-reinforcement and sensitivity to initial conditions and all that stuff that's so fashionable. But I think the great American tradition of economics is what used to be called institutional economics, which was made out of fashion in the 60s and 70s. And if anything, I would consider myself a kind of institutional economist, in the sense that I think when you've got very, very powerful and very rigid institutions within the system that prevent automatic adjustment mechanisms, you can get really deep imbalances. And the thing about imbalances is that they always reverse. So the question really is figuring out the different ways in which they reverse. I would say there are two really important imbalances in China, and I think there's anything very controversial about this. One is the income distribution, which is what we talk about when we talk about rebalancing the Chinese economy. The household share of GDP in China, as a result of policies that generated a huge amount of growth in the last 3 decades, has become the lowest, if you exclude one or two Arab oil sheikdoms, which are complicated for different reasons, has become perhaps the lowest we've ever seen in history. And this has really important implications for Chinese growth. And by the way, it explains why China has the highest savings rate in the world. It's not because Chinese households save a lot of money. It's because they consume a very low share of GDP, which is because they retain a very low share of GDP. So that's going to rebalance one way or the other, by which I mean the household income share of GDP is going to become bigger. There's just no way around that. But it could do so the way it happened in the U.S. in the early 1930s, where we saw U.S. GDP contract by 35–40%, and household income contract by only half of that, so it became a bigger share. Or you can see it in the Japanese way, where you had 20 or 30 years of Japanese GDP growing at 0.5% roughly, and household income growing at roughly 1.5%. It always rebalances, and the question is, how do you go about doing that? The second really big imbalance in China is one of leverage. I believe, and I think by now there's not too many people who disagree,
but I believe that China has an enormous debt burden, which is not the same thing as saying it has a lot of debt, right? If you borrow $100 and invest it in a project that's worth 110, your debt goes up, but your debt burden goes down. The problem in China is that it has a huge debt burden because it has invested in projects that are worth less than the cost of the project, so that the debt has grown faster than the debt servicing capacity. If you look at debt to GDP ratios, which in my class is a way to get an F if you compare countries on debt to GDP, it's a useless comparison, literally useless, not bad, useless. But if you look at it on that basis, China has one of the highest debt levels we've ever seen for a developing country, and that's assuming that we know where the hidden debt is, which we probably don't. And it's the fastest growing debt we've seen, maybe ever. So I think it's a safe bet to say one way or the other, the country will deleverage, but there are different ways you can deleverage. You can deleverage by growing your way out of the debt, which, by the way, no country in history has ever done. It's always the plan, but no one's ever able to pull it off once you have heavy debt loads. You can default and restructure the debt at a haircut, or you can inflate it away. There's lots of different ways. But the magic trick to deleveraging is pretty straightforward. There's no magic to it. It's just a question of assigning the cost of the debt to somebody, to some sector of the economy. So when you default and restructure with a headache, you've assigned the cost of the debt to your credit, with a headache, with a haircut. You've assigned the cost of the debt with a headache to your creditors. If you inflate it away, you've assigned the costs of the debt to savers, either the wealthy or ordinary households. If you do what Ceausescu did and you squeeze the hell out of the workers to pay down the debt, Romania paid down all of its debt in the 1980s, then you get put up for a firing squad. But then you assign the cost of the debt to the workers. So the way I look at it very simply is this is a question about how do you assign the cost of the debt, the whole issue of deleverage. So with that start, what I would argue is that there are four ways you can think about the Chinese economy. One way, the sort of the blissful way, which I don't think anybody explicitly believes that anymore, but I think a lot of people implicitly believe it. It's an implicit assumption in their models, and that is that basically we don't have a problem, right? That China's growing at 6.5%. Isn't that great? Most countries would kill for that. And so the economy is doing fine. Okay, it has a few problems, but basically we're fine. I want to address this issue of 6.5% growth because China's not growing at 6.5%, at least not in a meaningful way. And I'm not saying that it's because they're lying on the data. There's a little bit of that going on, but not as much as people think, I don't think. The reason I say that is because of what GDP means. And I won't get into a big discussion about it because in my latest blog entry, for those who are interested in a boring accounting topic, my latest blog entry on the Carnegie site, I try to address that. But the basic argument that I would make there is that when you're calculating GDP, GDP is just a measure of economic activity, and it's a measure of economic activity defined in certain ways. And what we need for GDP to be useful is a mechanism that causes this measure of economic activity somehow to conform with whatever it is that we want it to conform with. Much of GDP was developed during World War II. So at the time, among other things, we needed GDP to tell Washington the amount of resources available for the war. So GDP includes a lot of things that we might not normally think of as part of well-being, but that were part of the definition of GDP because it was developed during wartime. And one of the adjustment mechanisms is a mark-to-market mechanism. And to explain what I mean by that very simply, let's assume that there are two Chinas that are identical in every single way except in accounting treatment. So the same people doing the same thing, generating the same economic activity. Now, if in both of those Chinas you take 100 kwai and invest it in a project that's worth 20 kwai, in both cases, you immediately get a boost to GDP through the investment times some multiplier, whatever it happens to be. Now, what happens next is very important because in some cases, well, I shouldn't say in some cases, what you're supposed to do once you recognize that that investment is not worth 100 kwai, it's worth 20 kwai, is that you write it down. And as you write it down, that shows up as an expense, which shows up as a reduction in profitability, which shows up as a reduction in the value-added component of GDP, right? So you write up your GDP, and then you write it down to reflect the fact that the investment that you made had very little value. It didn't have the value that you put into it. Now, we said there are two Chinas that are identical. One China does this, it writes it down, and the other China doesn't. Those two Chinas are going to have two different GDPs. So right off the bat, that should worry us, because our initial assumption is that these are identical Chinas. They're doing exactly the same thing. So if GDP is meaningful, or if it's a reasonable proxy, they should have the same GDP, but they don't. A quick aside, some people say that's incorrect because, and it's always incorrect because they say that normally the normal wear and tear on assets doesn't show up in the GDP data. And for those who are concerned, this is not normal wear and tear. This is a charge to the value of the assets. This is an actual expense, and it has to show up in the same way any other expenses do. So if you don't do the expense, you're going to show up with a higher GDP. The reason I bring that up is because if you believe that there is a substantial amount of misallocated investment, then you must believe that either it's being written down, in which case you would have to show where it's being written down because it's hard to find it being written down, or GDP must be overstated relative to an economy that would write it down, right? So from that point of view, when people say, but everything's fine in China, it's growing at 6.5%, that's good. I would argue we have to be really, really careful there because depending on your assumptions, it might not be. It might be growing at much less than that. I happen to think it's probably growing less than half that rate. But if you believe that there is misallocated investment that's not being written down, there is some gap between this GDP as a proxy for value creation with its mark-to-market mechanism and GDP as not that. And that the same China can portray two different GDP numbers. So at the very least, you should be a little bit worried about what GDP actually means. But in my first scenario where everything is fine, of course, that's not happening. The 6.5%, 7% growth, that's the real growth, the way we would measure it in other economies, and bad investments are correctly being marked to market. So the assumption there then is that we don't have a systematic problem of investment misallocation, things are fine, and also that we don't have a debt problem. If you disagree with that scenario, and I think most of us probably do, then you have three other scenarios that are possible. One scenario I'll call the reform scenario, and it's always the scenario historically whenever countries have debt problems. When you have a debt problem, you do two things. You announce that it's a liquidity problem, not a solvency problem. You just need time. And then you announce that you should never let a good crisis go to waste. We're going to implement the necessary reforms that will allow us to grow our way out of the debt, right? This is sort of for a long time, this was the model proposed in China. I think still a lot of people believe it. I have a bunch of problems with that. The problem number one is a historical problem. And that is, as I've said, whenever a country starts running into debt concerns, this is always what they do. And I've yet to find a case of a country that was able to implement reforms sufficiently to grow its way out of the debt, right? I've never seen a case. I had this discussion last year with Martin Wolf, the editor of the Financial Times. And after I got home, a week later, he sent me an email and said, "You're wrong, I found an exception. It was England after the Napoleonic Wars." Now, for reasons I won't get into, I don't think that's an exception, but it's interesting to me that this guy who knows a lot about financial history had to go back 200 years to find an exception. It is hard to grow your way out of debt. And I would argue that there's a bunch of reasons, but perhaps the most important reason, and that's the topic of my next book if I ever get around to it, is that in finance theory, we know something that we don't seem to know in economics, and that is that debt itself can constrain growth for a whole bunch of reasons. We call these financial distress costs. But I would argue that that's the problem. When you have excessive amounts of debt, the debt itself becomes a constraint on growth. And whenever you think of a case of I said this in Russia last year, and I forget his name, an economist at Beida, said, oh no, but China did that. We grew our way out of our debt crisis in the late 90s. No, you didn't. The way that debt crisis was resolved is that basically the cost of the debt through negative real interest rates, that was severely negative. If you have negative real interest rates, you are basically forgiving debt at the expense of the lender, which is the household sector in the form of bank deposits. And the evidence of that should be a significant contraction in the household share of GDP, and the household share of GDP in the last decade collapsed, right? Household consumption was roughly 46% of GDP in the year 2000, which is a really low number, not unprecedented, but low. And 10 years later, it was reported to be 35%, which is a surreal number. All they did was they delevered by assigning the cost of the debt to the household sector. So what I'm going to argue is that historically, that's the only way we get out of debt problems. It's a question of paying down the debt or not paying it and assigning it to the creditor. And the key to that is always the assignation of the cost of the debt. Without that, nobody has grown their way out of a debt burden, and I don't think anyone can. But still, that's my theory. You could disagree with it. You could say it is possible for China to implement these supply-side reforms, in which case growth rates will pick up enough to outpace the growth in debt. And once that happens, we begin the process of deleveraging. Well, we've been trying this for 5 or 6 years, and it's getting worse, not better. So I would suggest that if it is possible, we haven't figured out the trick. It's quite hard to do. And I did a really quick calculation a few months ago in which if you believe that China's reported GDP growth represents real growth in value, forget everything I said at the beginning of this presentation, that China really is growing at 6.5%. If you believe that, it seemed to me that the necessary reforms would have to something like triple productivity. In other words, new investment would have to be 3 times as productive as old investment to catch up to the debt. That's a pretty tall order. For a while, we were told, oh, we just have to reform the financial system, right? If you reform the financial system so it does a better job of allocating capital, then it'll happen. But again, whenever I hear these things, I always try to look back at the history and say, okay, let's see examples of that. And I can't find any example of a financial system which had the type of reforms implemented that were necessary. We're talking about really radical reforms. I would suggest the closest case might be Chile at the end of the 1970s, beginning of the 1980s, where we saw a truly radical reform of the financial system. But remember that every single bank in Chile was bankrupt. The economy was in contraction. They just had a military coup. It takes quite a lot in order to have the ability to implement that nature of reform, it seems. But anyway, again, I don't want to say that the model is incorrect. It's possibly correct. It may be possible that with the right set of supply-side reforms, China will start to grow its way out of its debt burden. The caveats I would have is it's never happened. It might be that it's never happened because the debt itself becomes a constraint on growth. And we've been trying it for years, and not only have we not pulled it off, but we're falling further behind. And if you try to do simple calculations of the amount of productivity improvement, it seems pretty dramatic. It seems pretty hard to do. So maybe this works, maybe it doesn't. The third scenario is the scenario that I personally think is the most likely, and that is that there is simply no way China can grow until it rebalances demand towards the consumption side, because the investment growth, which continues to be the main or one of the main sources of growth, investment growth is a debt generator. There simply is no way to find enough productive investments without significant reforms in the legal system, financial system, and lots of other things, to allow you to get back on a track of investment continuing at these very high levels and not leading to investment misallocation. If you believe that, then you've got to bring investment growth down. But if you bring investment growth down, since that's a major source of demand, you've got to bring another source of demand up. And what are those other sources? One source is good investment, which is really taking us back to the second scenario, which I think is very unlikely. One source is the trade surplus, but China is just way too big to be able to grow through the trade surplus. And then that only leaves us with consumption. That's the only other source of growth. And if you believe, as I do, and I think it's hard to argue with the numbers, that the reason consumption is so low in China is because household income is so low. During 30 years of China growing at 10%, there was simultaneously mechanisms that transferred wealth from the household sector to net borrowers, most important being the interest rate, so that the household share of GDP contracted to the lowest perhaps in history. Then the solution's quite easy. You've got to increase the household share, right? While the economy is slowing and while investment is going down, household income has to continue growing. Now, how do you do that? If economic growth drops 3 or 4%, how do you get household income to grow at 6 or 7%? Well, once you go through all of the smoke and mirrors, it's quite simple. It's simply reversing the transfers. Instead of transferring money from the household sector to a group that ultimately we can refer to as the so-called vested interests, the local governments and the local elites, you now have to reverse that. So you have to transfer money from local governments and local elites to the household sector. There's a million ways you can do it, and the problem is so big that they're going to do them all. But you can privatize and then use the proceeds to increase spending on the household sector, education, health, or you can use it for payments, unemployment payments. There's a lot of different ways. You can eliminate the hukou system, which immediately makes migrant workers richer. It's going to be hard to do that, but theoretically, it makes migrant workers richer, makes local governments poorer because now their expenses go up. There are lots of different ways you can do it, but ultimately they boil down to the same thing. You've got to transfer wealth from the household sector, from local governments and the elite to the household sector. Now, the good news is that in China, unlike in most countries, the net position of the government is quite positive. There have been a bunch of studies. The most recent one I saw was by Thomas Piketty. He was looking at inequality in China, which of course is a problem. But what he said was that on a net basis, local governments are long roughly 40% of GDP. Now, in most countries, like in the US, the net position of the government is 0 or slightly negative. We have more debt than assets, but not in China, which shouldn't surprise because of all these wealth transfers over 30 years. Local governments should have assets. Piketty argues, I have no idea how accurate his numbers are, but they feel good. They seem like they shouldn't be wrong. He argues that they're long, that is, they have more assets than liabilities by roughly 40%. Now, that's not so simple. If it was a company, then the problem would be solved. You sue them, liquidate the assets, pay down the debt, everyone's happy. But of course, with sovereign assets, you can't do that. It's more complicated than simply liquidating the assets and paying off the debt. The local governments have two types of assets, SOEs and real estate, and it's incredibly unlikely that they're going to liquidate massive amounts of real estate because of the impact on the banking system. But still, at least in theory, there are good, solid reasons to think that it's possible to transfer assets from local governments and local elites to the household sector. The problem is when you look at the history of debt resolutions, as I said, it's always a question of assigning the cost of the debt to some sector or the other. What you find, no big surprise, is that the groups that are politically most vulnerable, for example, in the US, the household sector, ends up one way or another eating the cost of the debt cleanup, right? It's always easier to force the cost onto politically vulnerable sectors. The problem in China is that you can't really do that because if you force the cost onto the household sector, remember, rebalancing requires that we increase household wealth at the expense of governments, not the other way around. So and there are many ways you can do this. You can monetize the debt. You can use financial repression, which is what they used last time. There's lots of ways you can force it onto the household sector. But if you do, then we're not going to rebalance the economy. We're going to depend more than ever on an acceleration in investment growth and in debt in order to keep growth levels reasonable. So you can't really assign the cost to the household sector, or you shouldn't, because if you do, China's not going to grow for 30 years. So who else can you assign it to? You can assign it to small and medium enterprises. They're pretty vulnerable, but they're also the only really well-functioning part of the economy. They're actually very efficient, and you don't really want to cripple them. Because again, it's very hard to imagine that China will grow over the long term if small and medium enterprises are forced to absorb the cost of all of this debt. So if you don't do households and you don't do private businesses, who's left? Well, foreigners, but they're too small. You can't really assign the cost of the debt to them. And so then you're left with basically governments, local government and the central government, and for political reasons, it should probably be the local government. So that third scenario that I'm talking about involves two types of transfers in order to increase the household share of GDP, to keep consumption growing quickly so that you can bring investment down. You must transfer wealth from local governments and local elites to the household sector. And in order to deleverage, you must liquidate local government and local elite assets and use the proceeds one way or the other to pay down the debt. So you see the problem. The problem is that the solution economically, the best economic solution, is the assignation of the costs of the adjustment to those groups that most benefited from 30 years of growth, who have subsequently become very, very powerful. Now, we discovered, I apologize for repeating, I think I say this every time I speak here, but we discovered in China, we discovered the vested interests in the late 2007, early 2008. Before that, I'd never heard of vested interests, and after that, they were all over the press. And remember that it was in March 2007, I think, when Premier Wen gave that famous The Four Unbalances speech and promised it would become the top priority of Beijing to rebalance the economy. Had we read our Albert Hirschman, we would have then said, uh-oh, that's going to create a problem. That's going to create political opposition to the process of adjustment, and it seems to have done so. This is why I say that third scenario is the one that I think is the most likely. That Beijing understands what the issues are, understands how politically difficult it is to implement the necessary reforms, which is why the first thing the president did in 2012 or even earlier was begin this consolidation of power. Now, I don't like to talk too much about politics for obvious reasons, but I would argue that it's a necessary thing. The historical precedents are pretty clear about that. It is very hard to implement the types of reforms that Xi and the people around him need to implement in a decentralized system with very, very powerful opposition. And then finally, there's the fourth scenario, which is that so far I'm right. The first scenario is wrong. The second scenario is wrong. But instead of the third scenario, where you systematically go about forcing through the rebalancing and the deleveraging process, you don't. And in that case, it just seems to me pretty easy to predict what happens. Debt continues to grow. Now, there are constraints on the growth of debt, but people always say it's not a problem. We just get the PBOC, the People's Bank of China, to monetize the growth in debt. You can have debt grow as much as you want, as long as you have a credible central bank that's able to monetize it. Let's assume credibility is infinite. The problem there is that monetizing debt doesn't create debt. It simply transfers resources from those who are long monetary assets, which is the household sector through savings deposits. So if you allow debt to continue growing, at some point you begin to counter, and maybe we're there. Last year, about a fifth of the new debt was monetized. But at some point, you start putting downward pressure on the growth in household income. And remember, we've got to get it up, not down. So if you accept the fourth scenario, then this keeps on going until it stops. And when does it stop? We don't know. There's no formula that tells us when you run out of debt capacity. Lots of things. That's part of my next book. That's part of my first book too. Why do we have crises? The point that I would make there, though, is that one of the things that always kills me is when people say, you know, Pettis is wrong because we haven't had a crisis yet. And I always say, yeah, but what I said was we have a really big debt problem and we're not going to have a crisis. So the fact that we haven't had a crisis doesn't mean that it was wrong. The problem there is, I think, when you speak to most economists and you ask them, what is the problem with too much debt? They'll say, you might have a crisis. And no, a crisis is a brutally painful way, but it's a way of resolving a debt problem. The problem of too much debt is the too much debt itself. And if you don't have a crisis, as we saw in Japan, which has always been my favorite example of what we should look out for in China, In Japan, we went from an economy that everyone knew would become the biggest economy in the world by the end of the last century, which was roughly 17% of global GDP, which today is 6% of global GDP. And I don't think we are astonished enough by that. I can't find any case except in war where a country lost such a dramatic share of global GDP. To me, that's the problem with too much debt. It's that it stops growth, right? So let me recap then, and then we can open up to questions. The way I see it is that logically, there's only a few ways you can think about China. You can think that things are fine, and we don't really need dramatic reforms, that this is good growth, we just need to keep this going. You can think that the basic model is okay, but it's showing its age. We need reforms, call them supply side reforms if you want, that'll cause productivity growth to pick up so that we can get this temporary glitch where debt's growing faster than debt capacity, where we can get it behind us. And then the third model is, or the third outlook is, no, you can't do that either. We have a fundamental problem where we have to reverse, as we have in every single case in history of this type of growth model, where we have to reverse the model and bear the adjustment costs. And the question really is, what type of adjustment costs? And the best scenario, which is the one I think is most likely, is an orderly adjustment, but it means much slower growth, much slower growth. And like I said, we may already be there. And then the fourth model is that yes, all of that is right, but we're not going to do the adjustment. In which case we know what happens. If the adjustment always comes, the question is the adjustment directed by policy or is it not? And basically the difference between the last two is in one case it's directed by policy towards in a direction that is economically optimal, although politically difficult, and in the other case it's not. So let me stop there and open it up to questions or comments.
Thank you very much, Michael. First, let me make a couple points. If you're here, you know about the Carnegie Endowment website. If you want to read more of Michael's thoughts, he has China Financial Markets as a blog, monthly blog on our Carnegie website. Just go to ceip.org, go to experts, PETIS, and then they'll give you a menu of his writings. Secondly, we are going to have a session here at Carnegie on October 6th to talk about the politics, what's going on behind the scenes. So if you have questions on that subject, come back on the 6th. You will have received an invitation if you're here to hear from the China Leadership Monitor team, a number of really outstanding authors who I think represent the best of contemporary China analysis with their differing views on what we can expect from the party Congress. Now let me ask a couple first questions, Michael. One, as I looked around the room, I think maybe you need to explain what is the means by which you monetize debt. What are the choices?
Okay. Monetizing debt simply means money. There are different ways you can monetize debt. The classic way, and the way people always warn you, they say the reason you cannot simply allow debt to grow, so for example, a company wants to make a loan. It doesn't have the deposit base with which to make the loan, so it simply goes to the central bank, which creates the money or the accounts necessary for it to be able to extend a loan. That's monetizing the debt. Now, that represents a creation of wealth on the part of the borrower, right? Today, I had nothing. Tomorrow, because something that the central bank did, I am now able to borrow real resources. I'm able to increase my hold on real resources. I borrow the money and I bought some copper. So I'm now richer by that amount of copper. Now, logically, there's only two ways I could have gotten richer. One way is that the process of monetizing the loan somehow also created an increase in wealth, which is not as crazy as it seems. And then the other is that it was transferred, right? If I am richer, either that wealth was created or it was transferred from somebody else, right? Now, there's a big debate about which one happens. The fact is both happens. It really depends on the underlying circumstances of the economy. If you had a huge amount of unused capacity, a huge amount of unemployment, et cetera, then monetizing it is a form of Keynesian pump priming, if you like. You basically create purchasing power, and that purchasing power is immediately translated into additional economic activity. Unemployed workers are working, the factory that was closed is turned on, it starts producing stuff. At the extreme, which probably impossible to happen in real life, but at least theoretically, at the extreme, you could create the full amount of resources that you're using. So in that case, the economy is richer. But we have to figure out the specific circumstances under which that happens. It doesn't happen automatically. It happens under certain circumstances, and it may not be able to happen 100%, but it can happen substantially. In which case, we should be doing it, because it means that you're utilizing unutilized resources, including labor, to make the economy richer. But if that doesn't happen, then there is no way you can get richer unless somebody else gets poorer. There has to have been a transfer. And the way the transfer typically occurs, and it's the way we're always watching for, so when it doesn't occur this way, we say, it didn't happen, and that is through inflation. So the theory says you create the money creates inflation, and the inflation erodes the value of the savings of people who are long monetary assets, which in the US would be the rich. In China would be ordinary households who are savings deposit. The rich are often able to protect themselves, by the way. But in theory, if you are unprotectedly long monetary assets, if you have dollars in your pocket, or if you have a dollar bond that doesn't adjust with inflation, then inflation erodes the value of your wealth, and so it was simply a transfer. But it doesn't have to be through inflation, and in fact it often isn't, and in China it wasn't. You can do it through negative interest rates, which is how they did it in China. And that is, in the last decade, you had the Chinese economy growing nominally at an extraordinary rate, 16 to 20%, nominally, not real. Jesus, I'm very clumsy, sorry. Is it still working? Yeah. And you had the GDP deflator at 8 to 10%, which may be the best measure. We're always not comfortable with it, but it may be the best measure of inflation. And then you had the lending rate in the first half of the decade, I think was 6%, and in the second half was 7%. In that environment, the lending rate should probably be, we can argue, but between 12 and 16%. It was between 6 and 7. And you had the deposit rate, I think 2.5 in the first half of the decade and 3.5 in the second. So you see how it works, right? You put 100 kwai in the bank. A year later, you have 103 kwai, but it takes 110 kwai to buy whatever it was that you could have bought with 100. So you've lost money. And that money that you've lost has simply been transferred to the borrower. So that's what monetizing means. It means one or the other, depending on the circumstances.
Thank you. I think that helps a lot of people. Second question, in July, Xi Jinping gave an important speech to a vast array of assembled officials. And I think history suggests that a speech to that group preceding a party Congress indicates what we're likely to see in the government work report that will be made at the party Congress. This one did talk a lot about debt. The speech was focused on resolving the debt. Not so much on fiscal reform. Do you see any relationship between managing this debt problem and fiscal reform?
To me, it's really interesting because there are people who know what's going on. There's a small group. I'm not one of them. None of us here are one of them, I don't think. There are people who have a pretty good idea or a better idea of what's going on. I'm not one of them. I think he does. But from my point of view, it seems to me, and I'm just guessing, a speculation, it seems to me we've seen a significant split within the government about this whole issue of debt. And I would argue this goes back at least to the economic conference in December of 2015, when supply side, that was the big thing. My interpretation of what happened, and it seems to have been confirmed by those two famous people, daily articles that came out in March or April of that year, it seems that what's happened is, my interpretation, I want to stress this, is that the people around Xi were extremely frustrated and basically said, you guys, meaning I don't know who, perhaps the people around Li, I'm not sure, you guys have been saying that debt is manageable year after year after year, and it's getting worse and worse and worse at an accelerating pace. We have a problem with the debt. And I think that may represent the split between what I call the second of those outlooks and the third. If you believe that we're in that second thing, then debt is manageable. It's just a question of implementing the right reforms that allow us to grow our way out of the debt. If you're in that third group, and I think, and again, I really want to stress, it's very speculative, but I think the people around Xi and perhaps Wang Qishan may be in the third group. You've reached the point where you said, no, that's it. We can't grow our way out of debt. We've got to do something about the debt. So maybe that's what's coming out. We hear more and more about it.
I have to say, it's really becoming an incredibly fascinating episode for people who watch modern China. I'm prepared now to open for questions from the floor. When we call on you, please wait for the microphone so we can get this recorded properly. Secondly, identify yourself and then ask a real question. In the second row here, this. It's like a Princeton tie. I don't know if that's right.
I'm David Epstein from the Office of Net Assessment at the Pentagon. I wondered if you could give a historical description of your GDP adjustment. In other words, has this problem of unrecognized bad debt been infecting the GDP statistics since 1979, or is it more recent? How would you correct the overall record?
I think one thing that we can all agree is in the 1980s, China was significantly underinvested. No bridges, no airports, no factories, et cetera, et cetera. In that case, the best development model, I think, is what I call the Gerschenkron model, which is exactly what China followed, which a number of countries have done. Every investment growth miracle has done this. First of all, you have to raise the savings rate because it's savings that get invested. And how do you raise? Because you don't want to depend on foreign savings, it's too risky. And developing countries tend to have low savings. So how do you raise the savings rate? It's pretty simple. You constrain the growth in household income. That's what they all do, either direct taxes or indirect taxes. So as you constrain the household income share, you constrain consumption, you force up the savings rate, which they did very successfully. And then secondly, Gerschenkron pointed out that in developing countries, there is maybe because of time horizons, but the private sector doesn't do a good job of investing in all of the productive investments, particularly infrastructure. So that needs to be centralized. And they did that. And the result, as we saw, was the most rapid increase in investment, perhaps in history. And that's exactly what the doctor ordered, because China was significantly underinvested. So if you can increase investment, intelligent investment, but the joke back then was you could throw money in the air and it became productive, because they needed everything. So they grew very rapidly and very healthily. But at some point, you reach the point at which it is not so obvious where to invest. Now, one model says that point is the so-called capital frontier. That's the United States. You've got to catch up to the US per capita investment, and then you've got to come up with a different system. I think that's wrong. The other model says that every country has its own optimal level based on its own mix of institutions. The difference between a rich country and a poor country is not that rich countries have more bridges. It's that rich countries have a legal system, a financial system, an educational system, whatever you like, all of these institutions, which is why economists, we don't like to talk about it because we can't put it in a correlation analysis. We need this mix of institutions that allow our workers to exploit resources productively, and if we don't have them, the level at which they're able to product them is much lower. Now, where is that level? Once we reach that level, broadly speaking, speaking in really abstract terms, that's when you start to get the misallocation of investment. And I would say a few years ago, no, we're nowhere near that level. I think everyone agrees that we've passed that point, but when? I think it could have been as early as the late 90s, early part of the last decade. It certainly seems to have occurred in the last few years. So how much of an overstatement of GDP growth is there? I don't know, but it could be quite a lot. And the reason I say that is because I already mentioned Japan. Japan was 17% of the world and then went down to 6% of the world. I don't believe that. I don't think it was ever 17% of the world. I think it had a lot of bridges to nowhere that boosted GDP. It made GDP look much higher, because to me, to go from 17 to 6 is truly extraordinary. So there could have been an awful lot of overstated GDP in Japan. But there's another similar case. Every one of these investment miracles, we end up overstating because the adjustment is much worse than we thought. But remember that in the 1950s and 60s, the Soviet Union, too, was growing so quickly it was going to become the biggest economy in the world very, very soon. Paul Samuelson, our first Nobel Prize winner in economics, very kindly gave us the date. In 1961, he said, in 1984, the Soviet Union will overtake the US to become the world's largest economy. Didn't happen. I suspect that Soviet GDP was also significantly overstated, and I think now there's sort of a consensus that that happened. So that's not really an answer, but my warning is that from the historical precedents, it could be a big number. We don't really know. So there could be a significant overstatement of GDP here.
In the third row here, please. Oh, wait, please wait for the microphone.
I read somewhere that the percentage of China's income come from trade up to 45%. Is that statistic reliable? And if that's the case, we rely on trade is so heavy, how can you cut down?
Well, I think that number may be if you add total exports and total imports as a share of GDP. I know that in China the number is quite high, and it could be that. It could be that number. The being well integrated into the global trading system is usually a positive, not a negative. So I wouldn't see that as a bad thing for China. It does mean, of course, to the extent that you depend on the external sector, it does mean that you're vulnerable to events in the external sector. The global crisis in 2008, 2009 hurt China quite a lot. China's current account surplus contracted from 10% to 3%. And for those who are technically minded, that means the excess of savings over investment contracted. And there's only two ways that can happen. Either savings goes down, and the easiest way to do that is through massive unemployment, or investment goes up. And of course, Beijing chose to increase investment significantly to prevent a rise in unemployment, which may or may not have been the right thing, but that seems to be what happened. That's the danger of an excessive vulnerability to trade, but generally speaking, over the long run, I think that's a good thing. We now have another problem, which is the current account surplus. The way I think about the surplus is in debt terms. Demand consists of investment, which generates debt, consumption, which we would like to see rise without debt. So the increased consumption share we've seen recently may have been caused by the explosion in household debt, which is the wrong way to rebalance, and then by the current account or the trade surplus, really. And the way I think about it, very rough calculation, is that every 1 point forced contraction in China's current account surplus or trade surplus requires an increase, an additional 1/3 debt. That is 1/3 of the total amount of debt it takes to hit the GDP growth target. Right now, the amount by which debt is increasing in China is roughly 45 percentage points of GDP, maybe a little bit more, depending on stuff that's not counted. So as you can see, it's a lot of debt. So theoretically, and this is a really rough theoretically, if you were to contract the trade surplus by 3 percentage points, it would require twice as much debt to hit the GDP growth target. That current account surplus is a really important debt management mechanism, the way I think about it. So they're quite sensitive to that, which is why I think there's a lot of concern about a lot of the stuff coming out of Washington.
Here in the front row, please.
Hi, the name is Judd Harriet. Going back to your scenario where the debt is assigned to the public sector, assets are liquidated and transferred to the household sector. If, as you say, the assets in the public sector are severely overvalued, then doesn't this build in a kind of a deep constraint into this scenario?
Yes, I think there are a lot of assets there. I mean, there's certainly overvaluation in terms. I think we have to make a distinction. Sorry, I dropped this. There are two ways SOEs can have too much debt, or SOEs can be in trouble. One is that they're just producing stuff that nobody wants, right? We don't really need a lot more ships, a lot more steel, et cetera. those probably have to be closed down. So, they still have value. There's still value there. But, those are the ones that we really need to worry about. But I don't think that's the majority of assets. Local governments own lots of assets, not just huge SOEs, lots of other types of assets, lots of other smaller companies. And even among the SOEs, there is a difference between an insolvent SOE that has good operations, but is insolvent because it has too much debt. And there, we really understand that quite well in finance theory. There, if you eliminate the debt, the value of the company, the net value goes up. In other words, the enterprise, if you get rid of $50 worth of debt, you don't improve the enterprise value of the company by $50, you can improve it by $80, something, right? There's some number there. Reducing debt actually increases net value because the debt itself is a constraint on growth. And that's something we have lots of evidence for, lots of theory for, that's pretty well understood. So I would say there are three types of companies owned by local governments. There are good small companies that are fine, that are working. There are bankrupt SOEs that are in trouble because of the structure of their balance sheets. And once you clean them up, they're fine. And then there are, and I think there's probably less of this than we think, then there are companies that should just be closed down and gotten rid of. So the question is really how much of the first two do we have? Yes. Don't forget that for 30 or 40 years, while the Chinese pie was growing at 10 or 11%, and in the last few years, it probably wasn't really growing at 10 or 11% in value terms, but it was growing quite a lot. The household sector was growing at 6 or 7%, right? So while their share was contracting, the other share, which a lot of it is local elites and local governments, was expanding. And there's definitely value there. It's overvalued, but this has been going on for 30 to 40 years. So there's real value there. There's a lot of real wealth in China that wasn't there 20 or 30 years ago.
On the front row again, please.
Joe Pinder. So you're discussing a really unique economy. It's very large. It also doesn't have what most classic economies that are trying to work through this have, which is unfettered foreign investment, ownership, and has a legal system that allows the leakage of intellectual property. Can any of this be changed if the investment caps and the legal system?
Yeah, one thing is I don't think it's that unique. I think what's happened in China is an extreme version of something we've seen quite a lot. So there's actually quite a few things we can say about it. Now, this issue about intellectual property rights, I probably shouldn't say this, but I'm a little bit of an agnostic there because the truth is it's hard to find a single advanced economy that didn't steal intellectual property rights. Right? It's an old story. What's interesting to me is how that changes and why that changes. And in the US, it's sort of easier to look at it on the cultural side because it's sort of more clear. But what I look there is, when Dickens came to the US in the 1830s, it was to get lots of adulation, but it was also to complain bitterly about the fact that he was selling millions of copies in the US and not getting a penny. In the 1840s, they started significantly to reform the copyright rules, in part perhaps because of Dickens. And to me, maybe it's a coincidence, maybe not, but when you think of most of the great American writers of the 19th century, before then, they were mostly really rich people who could sit at home and write, and there weren't that many of them. We really saw the explosion in American literature occur after the imposition of copyright rules. And something similar seems to happen in music, because it was in the 1890s that you had significant implementation of copyright rules on sheet music, which is how you made money back then. And if you ask most Americans to name a famous American musician or composer in the 19th century, the only one we can come up with is Stephen Foster, right? And in the 20th century, I think the US it's the center of great music, right? Is there a connection? Maybe there is. I suspect there is. And I think in China, there is this recognition that at some point, you don't implement intellectual property rights to help the West, because no one ever does that. you implement them because it starts to make sense domestically. And I think maybe we're moving in that direction in China, but I'm guessing.
If I can. Ownership caps, you said?
You know, looking back historically, it's hard for me to find any clear reason to say that foreign ownership of assets is unambiguously good or unambiguously bad for development. We've seen both cases. The key issue for me could be savings related, because in the 19th century, rapidly developing countries, most importantly the United States, depended very heavily on foreign savings. And in the 20th century, we don't like that. And why don't we like that? It's because the dependence on foreign savings seems to increase the probability of crises. And the crises unravel all of the growth during the good period. So what's the difference? And I'm speculating now, but it seems to me that in the 19th century, most foreign capital inflows came in the form of equity investments. And I read a lot about this in my 2001 book. Financial crises are not caused by insolvency, they're caused by the structure of the balance sheet. And equity investments are very stabilizing, because when you're doing badly, you pay less. When you're doing well, you pay more. Debt's the opposite. When you're doing badly, you pay more. When you're doing well, you pay less. So maybe it's possible that the reason we don't like investment to be funded by foreign investment is because it comes in the form of debt. And maybe if we moved towards a system, because in the 19th century, most British investment was in real estate. This is the ultimate equity investment. If it came in more of an equity form, or at least in a more stable form, then maybe it wouldn't be such a problem. But that's really how I think about foreign ownership, nothing more sophisticated than that.
The United States principal foreign investors at the turn of the 19th century were Holland and the UK. And then they got involved, and they got involved in a war in 1914, and they had to sell those assets. They made a lot of Americans rich because they had to do it at fire sale terms.
Maybe the biggest transfer of wealth in history. Yeah.
On IPR, I was a backbencher in a room in Singapore in early 1980s when George Shultz, as Secretary of State, went to see Lee Kuan Yew, the Prime Minister of Singapore. They were personally quite friendly for a long time. And he said to Lee, you know, you've been stealing American product for your factories and things here. And Lee says, well, of course we do. We have to keep our boys in the party employed. And Tommy Coe, then the ambassador to Washington, stood up and said, Mr. Prime Minister, you know, we're now producing more to protect than we are getting value from what we steal, and it's time to change that. And they changed it. And I think that's a microcosm of what happens. You realize you have enough to protect, you move on. But you had another question here.
Michael Kurtzig, just to correct you, of course, you got Stephen Foster, Aaron Copland, Samuel Barber.
But Aaron Copland was more 20th century.
20th century. Well, Aaron was also in the 20th. I want you to comment a little bit about the labor market. In this country, for example, there are millions of jobs going begging because the education system is not keeping up with the demand, whether it's electricians or whether it's nurses, whether it's engineers. I recall in China some years ago, when I lived there on occasion, 6 million or 7 million people graduated from university, and the Minister of Education was fired. From what I think that was the case, and what I recall was that the reason why he was let go was because the people who graduated were not marketable. So is the Chinese economy, education system, keeping up with the demand of moving maybe from a hand type of economy to a minds, to a more thinking one? Or do we have a huge unemployment problem which of course is hidden by the government?
It's such a complicated question. It's very, very hard to answer it with much confidence. When I moved to China in 2002, they were graduating roughly 1 million. And today, yeah, they're graduating a little over 7 million. There's an enormous expansion in the educational system. But not surprisingly, there's enormous complaints about the quality of the education. So in China, you have this tiering of schools. You've got, you know, there's sort of like an Ivy League of 10 schools roughly, and then there's, I think, 42 nationally important schools. And then the quality starts to fall off very rapidly after that. And so the competition to get into one of the national schools, or particularly the competition to get into Peking University or Tsinghua, is just insane. Those schools, I think, are doing, you know, I'm prejudiced, we're doing a great job. I think they're doing a reasonably good job of training their students, but I suspect that as you go to the, you know, the bottom 2/3 of that 7 million, there can be real questions about the quality of the education. No, I'm a bit of a cynic there. As long as my kids are doing well, you know.
And his are doing well. We've got some really distinguished people here in the audience, and among them is Nick Lardy from the Peterson Institute, a true knowledgeable Chinese economist. Please.
Michael, my question is whether or not you're being a little bit too pessimistic about the challenge of the financial sector and the buildup of debt. Currently, non-financial sector debt, that is corporations plus households, is rough. There are different numbers floating around, but let's call it 260, 270. Now, there are plenty of economies that have grown for long periods of time with debt at that level. So this level is not unusual. I agree with you. What's unusual is the pace at which they've gotten to 260. So the one way of asking my question is, you keep talking about paying down the debt. You don't have to pay down the debt. All you have to do is get it to stabilize, and you might do much better than you expect. And if you think the goal is to stabilize debt relative to GDP, the magnitude of the challenge is more manageable than if you keep talking about paying down the debt, eliminating the debt.
Sure. Well, there are not many cases of countries with that level of debt that have grown well. There's Japan, which is not growing well. In fact, Japan is the model I think we should be thinking about for China. You can stabilize debt levels, you can stabilize it at very, very high levels without growth. We've seen that. Then there are a couple of other countries that are very rich countries, advanced nations. And one of the things that I always point out is that whenever we look at Chinese debt levels, we say, oh, compared to the US, compared to Japan. That's insane. You can't compare China to the US and Japan. All you have to do is get a graph, any period in time, or a graph of crises, and just graph debt to GDP versus debt per capita. And you'll see it's a positive sloping line. It's always a positive sloping line. And what that suggests to me is that more advanced nations, perhaps because they have more sophisticated financial systems, are able to function at higher levels of debt than less advanced nations. So when you look at China on that graph, you see it's a big outlier. If you compare it to the US, which is the wrong comparison, maybe it doesn't seem like a lot of debt. But aside from that, it seems to me we have advanced nations with equivalent levels of debt that aren't growing, and then we've got everybody else, basically. Now, remember what I said, the debt to GDP is the wrong metric, right? It's, again, I hope to be able to explain this in my book, but when you have too much debt, in finance theory, and I would argue in macroeconomics too, when you have too much debt, to be technical, it is when there is uncertainty about the future allocation of debt servicing costs, because it's the uncertainty that unleashes the financial distress effects. I'm sorry if I'm putting you all to sleep, but the key point that I want to make there is that too much debt is not 260% of GDP. Too much debt is when there is significant uncertainty about how those costs are going to be allocated. In the US, which is the one reasonably growing but advanced nation that is able to function at that debt level, there really isn't much uncertainty about the allocation of future debt servicing costs. The US doesn't have a debt problem. And the people who say they do look at the debt to GDP box, which is not the place to find out whether you have a debt problem or not. In finance theory, we know that different types of companies have different levels of debt, different optimal levels of debt, depending on the underlying volatility of the business, depending on the structure of the balance sheet, depending on lots of stuff, right? But I would argue that you cannot find a relevant comparison for China of a country with this level of debt that doesn't have a debt problem and that isn't facing a significant slowdown in growth. And I don't know, I mean, if you know of other examples, I'd love to take a look at them, because it just seems to me that the debt itself becomes the constraint.
More questions? Well, we've come to the end of the time here, and I want to thank all of you for joining us and asking provocative questions. And Michael, really thank you. I wish you well. He's got a sequence of meetings with key players this afternoon, and I hope you'll be able to give them some solid advice on how to handle our debt problems. Please join me in thanking Michael for the